A lot of people want to trade options because of the flexibility and the potential profits that it offers. But one question always comes up, and that is, how much trading capital do you need to start trading options? Unfortunately, it's not as simple as just throwing out a number. It depends on a few factors, and we're going to talk about those in this video. And as we get started here, there's a subscribe button down there. We'd love it if you hit that, and that notification bell helps us keep putting these videos out for you. So quick basic, what's an options contract? You should probably know this. It's just an agreement between two parties to buy or sell an asset at a certain price on or before a certain date. There's a lot of flexibility in options. That's what's so great about them. You can speculate on future directions of a stock or an ETF, or you can hedge against losses in the underlying asset if you're holding it. And the great thing about options, it's a lot less capital intensive than trading the actual shares. So here's an example. As I am saying these words, the price of Moderna, mRNA, is trading at $134.80. So if I was bullish on Moderna and I wanted to buy shares, I would need $134.80 times 100, or $13,480 of capital to control 100 shares. Why 100 shares? Because considering a options contract has 100 shares per contract. So if I used a simple in-the-money call option, I can control those same 100 shares. Again, each contract has 100 shares for $1,590. That is the mid price of the bid and ask prices of that $130 strike price. Pretty simple. So how do you determine your account size? Well, there's a few things that you have to take into account. Your risk tolerance, the strategies that you use, and the premiums for the options that you want to trade. So your risk tolerance simply is just how much capital are you willing to lose on a single trade, right? Your strategy is going to dictate how many contracts you need to buy or sell to make a profit. And finally, the funding requirements, they're set by your broker. And they're going to determine how much you need to put down to trade an options contract at their firm. Then we also have to consider your account type. If you're using a cash account, well, you're going to need 100% of the purchase price of the contract in your account to trade it. But if you're using a margin account, then you only need a portion of the purchase price. And that amount is going to depend on your broker's margin requirements. So let's say the requirement for an options contract is 10%. That means with a $10,000 margin account, you can buy up to $100,000 worth of contracts. Let's dig a little bit deeper here. During our options training that we have in NetPicks, we teach our traders that the margin account is our preferred account to use. As an options trader, you will appreciate the flexibility that they offer because it allows us to trade our favorite strategy, which are vertical spreads. Now, margin accounts, they get a bad rap, but that's mainly due to the lack of respect that traders give them. Using too much leverage has wiped out many accounts over many years for a lot of traders. The good news is that we don't use the margin that's available to us. We need the margin account because we like to set up option trades using strategies that allows us 5 ways to profit. That's our vertical spreads. All of our trades that we teach are risk defined. That means we know exactly how much we can lose on the trade. There's no surprises at all. And this allows us to control risk when using the margin account. Now, the PDT, the pattern day trading rule, still applies to option trades. Any account under $25,000 can only set up 3 day trading trades in a 5-day period. So this rule is going to prevent a new trade if you go past the 3 that you are allowed. Cash account. If you want to take a more day trading or active approach to options, the cash account may suit you a lot better. Like virtually every single trader out there can get involved with a cash account because the funding requirements are super low, depending on where you go, of course. But there's limitations. You can only trade long calls and puts, and vertical spreads are not permitted. The good news for you, with a cash account, you are not subject to the PDT rule. You could take as many trades as you want. So how do you manage risk? So once your trade's open, there's a few things that you can do to manage your risk, right? First, you can set a stop loss order with your broker, of course, which automatically will close out your position if it reaches a certain price. Second, you can use hedging strategies like buying puts or selling calls to offset some of your risk. Third, options expire. Okay, so if that underlying asset's not moving in the direction that you need it to go before expiration, don't be afraid to close out your position and take your losses or your small gains. But whatever your account size is, try to stay within 2 to 5% of the risk for each trade. The entire portfolio risk will not exceed 50% of the trading account. That's our rules. Now, you're more than welcome to be more aggressive or conservative, but for us at NetPicks, that's our comfort zone. And I cannot repeat this enough. Our favorite strategy is a vertical spread. If the price goes up, down, or sideways, we can end the trade in profit, and you can only do that when you use a margin account. So recommendations for account size. Again, I had to cover other stuff because it's not just cut and dried, right? So our trading approach is always about keeping our risk small, and we take a larger number of small trades. So doing that, we get to spread our risk around into different sectors and even instrument types like ETFs. And we have found that over time, we see more consistency with our results. So we believe that an account size between $3,500 to $5,000 is the minimum required to have a better handle on your risk. The lower amount of trading capital, the larger impact a losing trade is going to have on your account and can prevent you from taking further trades. I also mentioned a 2 to 5% risk on your account per trade. With the minimum account size that we talked about, you'd be risking about $175 to $250 on each trade. So a loss is not going to have such a devastating impact. There's a lot of mistakes made by novice traders, even experienced traders. Options trading is a great way to make money. Has risks, of course. Some of the more important ones, people don't know the difference between calls and puts. And that's one of the most basic things that you need to know. Know which types of option to trade. That's crucial. If you don't, you're going to make mistakes. It's going to cost you money. And it seems counterintuitive, right? To buy a put when you're looking to sell an instrument, right? But these are the types of things that you need to grasp. Not doing your homework. This means reading up on the basics of options trading. Learn about the different types of options contract. Familiarize yourself with all the risks that are involved. If you don't do your homework and you enter blindly, it is a surefire way to lose money trading. Getting emotional. This is vital. When it comes to trading, it's important that you remain calm and objective. When you get emotional about your trades, this could be excitement over a potential win or a frustration over a loss. It's going to cloud your judgment. It's going to lead to bad decision making. So if you find yourself getting too emotionally invested in your trades, you got to take a step back, reassess your strategy. The key to success is having a trading strategy and a trading plan, and you follow it consistently. Failing to manage risk, no matter who you speak to, who you listen to, what you read, risk management is one of the most important aspects of trading. When you trade options, you have to be aware of the potential for loss, as well as the potential for gains, right? When you fail to properly manage risk, it's going to lead to big losses, right? It's vital that you keep risk in mind when entering into any trade. And again, 2 to 5%, that is our sweet spot for risk. Holding on to losers. Look, in life, it's hard to admit when we've made a mistake. Sometimes the best thing we can do is to cut our losses and move on. Holding on to losers for too long, that is a mistake. And a lot of people make these. Admit defeat, move on. Instead, they hold on to losing positions. They hope it's going to come back. This almost always ends up costing them even more money in the long run. If you find yourself in a losing position, don't be afraid to admit it's not working out. Just move on to better opportunities. And if you followed your trading plan and your trading strategies, then you weren't wrong. The trade just didn't work out. Top 5 points to remember from this: losing trades should have no more than a 2 to 5% impact on your account. Common mistakes: not knowing the basics of options, not doing your homework, getting emotional, not managing risk, holding on to losers. You need to do your research. You have to know about options. You got to have a trading and risk management strategy in place. If you find yourself in a losing position, do not be afraid to admit it. Move on. There is no one-size-fits-all answer when it comes to how much money you need to start trading. But as a minimum, we do suggest an account size between $3,500 and $5,000. Now, everyone wants to make more money, right? Stocks, you can do it. And one way to do that is by investing in dividend stocks. Now, dividend stocks, these are just companies that pay out a portion of their profits to shareholders. Typically, it's a cash payment or shares of stocks. You can do that as well. Our list of 101 top dividend stocks, this can help you get started. And this is a comprehensive list of some of the best dividend-paying companies that we watch, so you can find the right one for your portfolio, right? Do your research. It's a free report. You can download it. The link is above, and it's below in the description. Thanks for watching. Make sure you hit like, subscribe, and we'll talk to you soon.